All right, is that everything from financial statements?
Do you want like the balance sheet too?
All right. Okay. It's still thinking about something. So we're going to start today with our traditional logic puzzle. Who is excited for a logic puzzle? And then we'll continue talking about principles of taxation. I know it's not a very exciting subject, but it's important to know the basic frameworks and the basic structure of it, just so we know what we're dealing with. And then maybe we'll talk about investment returns and time value of money and exponential growth and good things like that. And we'll do that once something starts happening over here. Thank you. Have you guys started to take a look at Dominion yet?
I could not open it on my computer every time I tried. It just didn't work.
What browser were you using?
Yeah.
Try getting the latest Firefox. I know it works in Firefox, but probably also works in Chrome. So just try another browser. If all else fails, you could just go and get work on the university computer or something. And if somebody says, "What are you doing playing the game?" You can be like, "It's homework." It's homework. Right? Okay, so again, I'd like to be able to discuss our results on Tuesday of next week. So try to get your game on by then and see how that works out. Okay, so here's our previous puzzle. Anyone have a solution to propose? Yes.
A quarter and a nickel, because one of them is not a nickel, but the other one is.
All right, that's it, right? It was a sneaky, tricky question. So one of them is a nickel, but the other one is, right? Haha. Okay, so I just thought I'd throw that one in there for fun. So today's puzzle, here is the setup. Right, the background is that we have the island of knights and knaves, and the knights always tell the truth, and the knaves always lie, and everybody is either a knight or a knave on this island. All right, so this is the setup for our puzzle for today, and the actual puzzle is this. And for the latecomers, know your bank details. Okay. All right, well, ready or not, let's move along. I will, as usual, post the slides on Blackboard, so if you want to rack your brain over it over the weekend, you're more than welcome to it. Hey. So last time we discussed the basic ideas of the tax laws in the United States, right? We start with basically the gross income that is all the money that we get. Right? We have certain deductions, and then at the end we have, hopefully, as small as we can get it, taxable income, and we pay taxes on that. And we talked about the tax brackets. So approximately, roughly to the nearest thousand, these are the 2013 tax brackets. In general, what it means is that we have a different tax rate on different parts of our taxable income. Right? It's not that, depending what your income is, you just get to pay a certain percentage, right? So, for example, again, let's imagine that we have $100,000 of taxable income, right? So after all the deductions and everything, come up with a nice round $100,000, just for an example, right? So let's see if we can calculate how much tax we're going to owe on this $100,000 taxable income. And here we're only talking about federal taxes, right? There are obviously a lot of other taxes involved. We'll get to talking about those in a little bit. And so take a minute and see if you can find how much tax we'll owe on the $100,000 of taxable income. Given these brackets, right? So you don't assume that they are exactly that. If you don't have a calculator on your hand, just write down how you would calculate it if you had a calculator, right? So don't So these are the next 25. Otherwise, if you happen to have, they have PE classes, they have, I mean, we have to do that. We're doing one more thousand, you're going to be crazy. So that means it is better for you not to be able to that and you don't have to, right? So because that wouldn't, you don't want to work that way, right? So you want to the marginal dollar income to still be a positive value, right? Otherwise, you're going to do that, that's going to be bad. That's going to be bad for you to make it too much. It's not thank you. Alright, so what do we have? Okay, so that's our total. Okay, I'll buy that. Sounds reasonable enough.
For the taxi?
I mean, either way, then that's where it's taxes. I haven't calculated myself how much I wear that. Sounds approximately. And that's just the federal tax.
Is this like just pretty, like the, can't you like links safe transactions?
Yeah, I mean, as we discussed on the previous slide, right? We have a bunch of deductions. Like if assume that 100,000 is after all the deductions. That's the way to assume it to make a simple problem. Right? Reality, if you gross income of 100,000, then you're going to subtract a bunch of deductions. So your taxable income may be something like 80,000. Probably get what they're going to deduct. Right? So we're assuming that in order to take into account all the deductions in the taxable income. Right?
So first 9,000 times 10% is 900. So you're going to take the 900. Now take the 99,000. One is like 6,000.
Okay, so let's talk about how this works, right? So what these brackets say is that on the first 9,000 of our income, taxable income, we're going to pay 10%, right? So 9,000,
Just to subtract
we pay
the next
10%.
did a little
So how much do we pay?
99,000 minus 36.
On this 9,000?
Didn't do
$900,
anything.
thank you.
So that
Right? So 900. So on the next 25,000 of our income, we pay 9 to 36,000,
times
right?
50%.
We pay 15%. So we pay 25,000 times 15%. How much is that? Right? And so on the next 36 to 88,000, which is 52,000 if I'm not mistaken, yes. The difference between 9 and 36,000 is 27. You are correct. Okay, I'm glad you guys are paying attention. At least some of you, right? It is indeed 27, not 25. Alright, so 15% of 27, is that 40, 50? Okay. Alright, thank you very much for pointing that out. Now, the difference between 36 and 88 is indeed 52, right? Just want to double check here, right? So on the next 52,000 of our income, we get to pay 25%, which is how much? 13,000. Exact. Oh, yeah, 52,000. Okay. And so finally, right, we have $100,000 in total of taxable income. So that means we have another 12,000 remaining if we haven't paid tax on that, right? So then we have 12,000 at 28%. And what do we have for that? And so what is our total tax liability then? Right? Is the sum of all of these, right, all of these brackets. So what do we get? Right? Everybody with us? Makes sense? Right, so the point is, so number one is that we don't just see which bracket we fall in and pay that much tax. Right? We pay bit by bit for each, for each bracket in the tax. And the reason for that is that let's imagine that if we happen to have, exactly $87,000 in tax, right? We would say, okay, we're paying 25%, right? If that, that's kind of calculated. And then we say, well, what if I make an extra 2,000? I would have 89,000, and I would pay 28%. You would actually end up netting less money if you make more money, right? So that's kind of not a very good situation, right? Ideally, it is to be hoped that for every extra dollar you make, you have some positive value that you can get at, right? Whereas if it was just whatever part of the bracket you pay, you fall into, you pay that much tax, there would actually be regions of taxable income where making more money makes you worse off, right? That's not the way it works. It's a good thing, but it's not the way it works. Right? But this way, for every extra dollar we make, we're better off, right? We pay the marginal tax on just that dollar, and we don't increase taxes on everything else, right? That's the little bracket, third, at the end, third, final bracket. So isn't that extra tax? Now, we paid $21,310 on $100,000 of taxable income, right? So that's an average tax rate of about 21%, right? Now, it is a very important difference between the average tax rate and the marginal tax rate. Right? The average tax rate is, basically on average on all our incomes, how much taxes that we pay, right? Now, of course, realistically, like we said, 100,000 is the taxable income. Hypothetically, we had a gross income that was higher than that, and we took some deductions, right, and then we paid some tax. So relative to the gross income, our average tax rate would be even lower, right? Because it would be 21,000 out of whatever the gross income was, right? You may imagine that we had 120,000 gross income, right? And after some deductions, we got 100,000 taxable income, right? Or something like that. And so our average tax rate on this 120,000 gross income would be 21,000 out of 120, right? Which is something on the order of 16 or 17% average tax. Make sense? Right, but we can also look at the marginal tax rate, and the marginal tax rate is how much extra value do we get from an extra dollar that we earn? And to answer that question, we're not going to look at the average tax rate, right? What we're going to look at is the marginal tax rate. And in this case, an extra dollar that we earn is going to be taxed at 28%, right? So as far as our decisions, for example, to save versus spend some amount of money, and we're thinking how much more money we're going to have to earn to make up for it, we're going to have to look at the marginal tax rate, right? Which is how much tax we have to owe on the extra dollar. It's not about the average tax. The average tax rate is going to be relatively low because of the relatively low percentages we will bracket and average in everything, right? But that's not going to help you for the marginal dollar, right? Because these brackets we already passed them and we were all the way down to, right? So that's an, that's an important thing to think about, right? In general, in many areas of economics, the idea of the marginal effect rather than the average effect is an important component of decision making. You want to know, do you increase your sales? What's going to be the marginal profit for you, right? So, for example, if you already have a bunch of fixed costs that you have incurred no matter what, maybe your extra variable cost is relatively small, and you have a big effect from selling some extra units. If you can make them for a relatively low marginal cost, but you charge the same price, right? So marginal effects are an important concept in general. We'll probably encounter them in several times as we go along the course, right? So keep that in mind. Now, any questions about this basic idea here? All right, so and then if you don't have to really remember any of these particular brackets or tax rates or anything, because number one, these things change every year. So there's no point in remembering what it is, right? The main idea is so that you understand the framework of how these things work, right? What is the basic structure of taxes and how they affect your net after-tax result, right? Make sense? So, and again, even if you are preparing your own taxes, right? You could use that if you happen to be just doing everything on your own in a spreadsheet. You would actually use this kind of methodology to calculate your tax. These days, relatively few people just do it on their own. There is software that basically automatically calculates your tax liabilities, right? So even if you don't pay for a CPA to do things for you, right? Like on the IRS website, there's like a bit of kind of a web form that you fill out with your income and your deductions and things like that, and it automatically helps you out to prepare your taxes. So you don't have to manually do it, but it's a good idea to know what is actually being done, like what's happening. Make sense? Okay. So, now that was only the federal bits, right? Was the tax brackets that we looked at on the previous slide. That was the federal taxes. Now, in the United States, we have a lot of other special taxes happening, right? So, first of all, we have state and local taxes. Now, how many states are there in the United States? Yeah, I know. So, in every state, there is a different state tax rate. Right? So, again, just remembering what all the different states do doesn't make sense because number one, it's different in every state. Number two, it changes a little bit every year, right? But the point is that when we pay the federal tax, we're not done yet, right? There is also state tax. And state taxes differ significantly among states. For example, New Jersey has one of the highest rates of state taxes, which is just around 10%. Right? And there are some states that have really low state taxes, like Delaware is around 0%. Right? So, depending on where you are, that would have a different impact on your average tax rate and as well as your marginal tax rate for every extra dollar you make, right? An extra 10% in New Jersey, 10% is like a lot, right? And then there's local taxes, depending where you are, they're somewhere on the order of like a 1 to 3%. If you live in a big city like Philadelphia or New York, there will be like a extra super special high city tax that you have to pay for the privilege of living in this wonderful big city, or something like that, right? I mean, in general, there's a high population density, there's a lot of infrastructure that needs to be supported and maintained, right? There's probably a lot more bureaucracy that is required to manage millions of people. So like in a large city, you have a larger city tax. If you live in some more less dense environment, you have a relatively smaller local tax. But again, it's like another 1% to 3%. I don't know what it is in New York, but it's ridiculous. And Philadelphia has like an extra 3% or something. Right? So there's some more tax rate. Right, then on top of that, there is the FICA tax, which is Social Security and Medicare. And in general, that runs at around 15%. Now, if you're an employee of some firm, in general, the firm, like the company and the employee, share this tax 50-50. So you would pay 7.5% of that, and the firm would pay the other 7.5%. If you're self-employed, you pay the whole 15%, but there's like a special deduction you can take on the other half. So we can think of that being, as far as net taxes go, we can think of that being as another 7.5%. Right? And 7.5%, again, nothing to sneeze at, right? 7.5% of your taxable income is a lot. Right? So once you add all of these things together, like your local, your state, and the federal, even if you don't make that much money, your marginal tax rate on every extra dollar that you earn is, unless you just make very little money, right? You make $10,000 tax liability, right? And if you make some kind of a reasonable, average type of income, once you add everything up, you're going to be in about 30% marginal tax rate, everything taken together. Right? And if you make a relatively high amount, if you make like 100,000 or 150,000, you're going to be in a marginal tax rate of maybe 40 or 45%. Right? So, just consider just one thing to consider, that again, for every extra dollar you earn, depending on how many dollars you already earn, you can be eating only 60 cents or so, right? 87, right? Make sense? And so again, that brings us to the point that it is a lot more efficient to save an extra dollar than to try to earn an extra dollar, right? So always keep one. And there are a lot of reasons to save an extra dollar, and we will we'll talk about investment returns and long-term growth rates and things like that, and it will become even more egregiously obvious that saving an extra dollar is really good. But for the moment, right, just looking at the tax picture, it's we have a pretty good society here. We're safe. There's not a lot of crime. You can go down the street, you can hang out, you can walk into the store and buy milk, and be pretty sure that it won't kill you, right? So all of these things take resources to maintain. Right? It's not to say that paying taxes is bad. Of course, there is something to be said that there's a lot of government waste. There's a lot of people who just hang out and don't do anything or whatever, right? But no system is perfect, right? We have to take certain deadly losses and agency costs along with getting stuff. But at the end of the day, just we all got to think, what is the net effect on my utility? What is the net effect on my income? And we have a fairly large impact of the marginal tax rate on our decisions, right? Okay, anyone have any questions or thoughts or things? Okay. Oh yes, and let me talk about some other special cases. All right, so here we have interest and capital gains. So when you put your money in, say, a bank, right, or like maybe you have your money in a CD or whatever it is, and you get interest on your savings account or your CD or whatever, right? Guess what? That interest is part of your income, right? And it is taxable at your regular income tax rate, right? So if you have, again, in our earlier example, if you have $100,000 of taxable income, and then you say, hey, by the way, it looks like I also got some interest, right? So that would go, you would add an extra dollar, and that would get taxed at the 28% marginal federal tax. And then there would be state tax, right? So even on your interest income gets taxed basically as your ordinary income in general. So what does that mean? That means that if you're getting 1% interest on, say, your savings account, which you could approximately get if you look really hard and find some low overhead banks that give you a fairly decent interest rate on just a plain savings account, which is true. Right? After tax, you're actually only getting only 6% interest. Right? Because you have to pay tax on your interest. So if, for example, inflation is 3%, and you say, hey, I'm getting 1% on my savings account, so I'm not actually losing 3% of my purchasing power per year. I'm only losing about 2%, right? But I make up for one of those percents by getting interest. Well, guess what? You get taxed on the extra 1% interest. You're only making maybe 0.6%, so you're losing 2.4% of purchasing power, not 2%. Right? So it's another consideration that enters into really not, besides the fact that we already talked about that you won't get, a bank is not a place to invest money, it's a place to get money for safekeeping, if you don't want to keep it in the mattress, right? But, because you never get like an interest that is higher than the rate of inflation by putting your money in the bank. Right? But it's even worse because you get taxed on any meager interest that you put there, right? So you don't want to do that even more. Okay? So now another issue is the capital gains and losses. Now when you invest in, say, the stock market, you get dividends. Dividends get special treatment, right? The dividends have a special dividend tax rate, which currently is about 15%, which is a lot better than 28%, right? As far as marginal tax goes. So the dividends are pretty nice. The other thing is capital gains. If you buy a stock for, say, $50, and later you sell it for, I don't know, $100, you just made a $50 profit per share, right? So that's considered a capital gains income. And capital gains also gets a special tax treatment, which currently is, again, about 15%, which is better than 28%. Now, the capital gains tax rate only applies if you have held your investment for more than a year. So if you buy it for $50 today and you sell it for $60 in 2 months, well, it looks like it's capital gains, right? Because you just bought it for cheap and sold it for more, but because it was a short-term capital gain, it gets taxed as your marginal, as just your ordinary income, right? So first of all, you're thinking, OMG, what's with all these rules, right? Well, that's the complexity of the tax code, right? There are all these rules. But another thing is, because there are all these rules, they actually enter into the decision of what to do with your investments, right? If you think, well, if I sell it today, I'm going to pay 28% marginal tax on my capital gains, but if I hold it for another 5 months, I'll be holding for more than a year, and I'll only pay 15%. Well, maybe you'll just hold it and hope that it doesn't go down, right? Or something like that, right? And again, remember also that capital gains do not get taxed until you actually realize the gain. If you buy a stock at 100 and then it goes up to 200, but you're still holding it, you haven't realized the gain, you don't get taxed on the hypothetical gain that you would have if you sold it, right? You only get the tax only materializes once you capitalize on the gain, right? Once you realize the gain by selling the appreciated asset, right? So that's another consideration that enters into your investment planning, as we'll discuss in a little bit after we talk about investment returns and exponential growth and things like that. We'll come back to that. But so there's a lot of there are taxes involved in many areas of sort of income, investment, things like that. So there is always a consideration of what happens with my tax liability, right? And then there is also talk, like in Congress these days, to like raise the capital gains tax or like dividend tax or whatever. So there's no telling what's going to happen with it or whatever, but currently that, right? Okay, any questions so far? Okay. Taxes, aren't they exciting? All right. Just keep these things in mind. Again, as I said, you don't really need to know like what are all the details of what are the rates, what are all the special exceptions, etc. But you kind of do want to know the basic idea and the basic framework. So for the second homework assignment that I will probably post sometime in the next week or so, right? Just consider that you might have some problems dealing with your taxes and stuff. And I will tell you what rates and assumptions to use for most of them, so you don't have to like, go and look things up, unless the problem is to go and look something up, right? But just to have an idea and understanding of how things work, right? Because for now you probably haven't really had to think about it because being students probably don't have a whole lot of income, right? I remember when I was a student, you didn't have to worry about it. But as you go out into the real world, eventually, maybe in a few years, all of these things are going to start coming back and biting you in the rear. So you'll be glad that we discussed it. Okay, we already discussed the idea of marginal versus average tax rate, so that's fine. So now let's talk about compound interest, time value of money, and things like that. So let me ask you a simple hypothetical question, right? So let's imagine we have $1,000. Who wants $1,000? I'm not going to give it to you. Okay, so let's say we have $1,000. And so one question we ask, okay, let's, we'll work with this, as an example, we'll work with a 10% rate block. It's a nice and round number. As it happens, in the long term, the average rate of return on a diversified index of equity is somewhere on the order of 8 to 10%, right? So when we say, let's imagine we get a 10% rate of return, you can say, wow, I remember that's probably the long-term average expected return on an equity index, right? So let's imagine we're getting 10% on a 10% return on $1,000. So what will be our total value of the investment at the end of 1 year? You can all just look at it in your head. You know that it is plus your initial investment, which is $1,100, right? So if you get a 10% rate of return on this investment, you say, hey, so in a year I will expect to have $1,100, right? Okay, 10%, $1,100. Pretty nice, right? So then I will ask you, well, what if you hold this investment for 1 more year? How much money do you expect to have? And it will be 1210. Why is that? Right, you will get 10% on your new value of 1,100, right? So from year to year, you get 10% on what you have. All right, 10% of that is 110. So add that, you get 1210. All right, you hold it from 1 more year, and you'll get 10% on 1210. All right, so that's maybe it's really an obvious idea, and it possibly is, but it is important to realize that the monetary amount of growth every year is larger, even if the percentage rate of growth is the same every year, right? It's not that you get an extra $100 every year forever. Instead, you get 10% every year forever, which means that every year you make slightly more increment than the previous year. Yes?
So the 12 is, so we have the original 1,000 plus the 100 in the first year, so that's the
Right.
But then the 1210 is just is with that, so you're only making, are you making an additional 1210, or are you just adding the?
Oh, we're counting how much in total we will have, right? So you start with 1,000, and in 1 year, you made 10% of $100. So it is 1,000 plus 100, so 100. Now here, in 1 year, you make 10%. 10% is $110, right? So you add that to your previous principal, and you make 112, right? Everybody agree with that? Okay. So, I mean, it seems that it's not very significant, right? You had 100, you had 110, and the next period, you had 121, right? So, then that's 13, 41, right? Etc. But the thing is, it doesn't look very significant at the start. But we can ask the following question. Let's imagine I take this $1,000 and I invested at an average expected rate of 10% and sit in it for, say, 50 years. Right? I mean, you all are probably around 20 years old, right? So probably you're thinking, my outlook to average retirement age is about 50 years, right? So now it's about 65, probably it'll raise it a little bit, 70 like that. An easy assumption to make because the human lifespan has been increasing, etc. You have 50 years to wait until you say, have enough of this, I'm retiring, right? So, without doing any calculations, like ballpark, can you think how much money will your $1,000 go to after 50 years at 10% per year? So make an intuitive ballpark estimate of how much you think it would be. And later on, we'll check it by actually doing calculations, but doing it. And it doesn't matter, there's no wrong answer. Like, if you happen to be wildly off, that's fine, right? There's nothing wrong with that. I would probably be wildly off if I tried. So we have an estimate, 20,000. Would you, somebody else have anything else? 10,000, I have an estimate, 10,000. Anybody else? But there's no calculated yet.
No, I'm not going to.
Okay. 200,000, okay. We got 200,000 optimistic. Okay. Anybody else? Okay, we got 60,000. Anyone else want to venture a guess? 15? Okay, we got 15. Right. Anybody have anything outside this range or would like to put your mark on our sample here? Come on, you guys, maybe yes. I need to put my guess in to increase our sample. All right, do you have a guess? No, you don't have any idea. Like, let's say, for example, you're walking down the street, right? And somebody comes up to you and, okay, see, there you go, you have a guess. All right? Go ahead, you already have a guess. Do you have a guess? Now, imagine you have to make a good one, right? You're walking down the street, somebody says, you're putting $1,000 into 10% 50 years, and if you guess how much you have at the end of 50 years, within $5,000, I'll pay you $100, right? 50? Okay. All right, so you imagine that you want to make a good guess. Okay. So now let us see if you can calculate precisely what it will be. Yes.
$117,390.
$117,390?
Yeah.
And okay. Okay, before I ask you like, how do you calculate that, what do you guys think? I mean, it looks like it was generally much higher than most of you expected, right? Except for one guy. All right, so that is, that's the thing, when you estimate things ballpark and you are looking at an exponential growth, the human mind doesn't deal very well with exponential growth. Right? The human mind deals very well with linear things, right? It's like, if something grows at $100 a year for 50 years, you say, oh, that's easy, I'm increasing by $5,000, right? Linear things are very easy, but exponential, we tend to underestimate exactly what it means for a function to be exponential, right? And so it is really, don't feel bad about being underestimated. It is expected that even people who know about exponentials, if you think about it, I know that it will be really high. They just haven't calculated it. And even people who know exponential will underestimate it, right? So people who don't, will underestimate it even more, right? So, how do you calculate 170?
I took 1,000 and multiplied it by 1.1 50 times. So it was a 10% increase in the last time.
All right. Everybody heard that? Do you understand it? Okay. Well, let's look at this example here, right? So how did we get from 1,000 to 1,100? Well, we said I will earn 10% interest. So that will be 1,000 times 0.1, right? 10%. And I also get to keep my principal, which is 1,000. Right? So my total is 1,000 plus 10% of 1,000. Now let's factor out the 1,000, and we get 1,000 times 1 plus 1. Right? Everybody with me so far? Yes? Maybe? You okay with that? Yeah. Okay. All right, 1,000 times 1 plus 1,000 times 0.1. So there it is. All right, so that means we can say 1,000 times 1.1 will produce our result at the end of the year. Right? Now, in the next period, we go from the 1,100 to get another 10%. So what do we have? We have 1,100 times 0.1 plus the original 1,100, which is 1,100 times 1.1. But remember that 1,100 is 1,000 times 1.1. We can write it down as 1,000 times 1.1 times 1.1. Right? And so then to go from here to here, we grow by 10% again. What happens? We keep our principal, and we add another 0.1, right? 1 plus 0.1 times the principal of 1,000 times 1.1. Right? Are we seeing the pattern here? Is it making sense? Right, so in this way, we can say that, we could do it every year, but if we could say, well, I know that if I grow by 10% every period, I'm just multiplying by 1.150 times, which I can just write down as 1,000 times 1.150 power. Right? We can look at powers up. We're multiplying by 1.150 times. Right? Everyone with me? Do you have any questions? Yes.
So like in real life, you actually do this, or like do they cut it off at a certain point? If return or getting interest in
I mean, if your investment gives you an interest, it just gives you an interest on whatever your principal is. So there's no cutoff. If you have all the time in the world, you just let it sit there and grow, right?
And what's an average percent
Who is they? Like what kind of investment are we talking about?
in general?
Well, I mean, as I mentioned, like historically, the average rate of return on a diversified index of equities, stocks, right? Stocks, is about 8 to 10% per year on average. Now, that is not to say that this is a fixed interest rate that you expect every year, right? Sometimes it will return 30% or 50% per year, and other times it will return minus 20% or minus 30% per year, right? There's a lot of variation in that. But on average, over the long term, historically has returned about 8 to 10%, right? So, again, it is not precisely correct to model the average as the rate that you will get, right? But it is relatively close, and it is much easier than trying to model the rate that you will get out of some kind of random distribution, like either the normal distribution or the t-distribution or something like that. It's just much easier to estimate the thing, oh, let's pretend we get the average rate, right? You'll get fairly reasonable estimate by doing that. You get an idea of what to expect, right? But yeah, I mean, if you invest your money and let it sit there for 100 years, and if you get an average 10% return, you'll get a crap load of money at the end, right? Yeah, nobody is going to say, okay, after you get 100,000, I'm not going to pay you anymore. Because guess what? If they do that, they'll take your money and put it somewhere else, right? They can just say, oh, we don't want to pay you anymore, and we will give you back your money. Well, then they still do it. Right? Make sense? I mean, that's a good question, right? It looks like there should be some kind of limit, but there isn't. Exponentials grow and grow and grow, right? And here's the thing, right? So, 1,000 times 1.1 is 50, right? 172. So that means that if you take $1,000 right now, today, and you put it into your IRA and wait until you retire, that $1,000 is going to turn into $172,000. Give or take a few tens of thousands, depending on the variation of the actual interest rate that you earn, right? But you won't actually earn 10% exactly every year. But again, as we said, on average, 10%, right? So give or take a few tens of thousands, you expect approximately this magnitude, right, at the end. Right? Maybe it will be only 100,000, or maybe it will be 150,000, right? But it's definitely not going to be somewhere on the order of 10,000, right? If you're expecting to get approximately an average rate of 8 to 10%, it will be a relatively large amount. Yeah.
Does your interest, do you start out with a lower interest rate if you invest more money to begin with? Like if you invest, let's say, like $10,000 right now, would they still be 10% of that?
Okay, so I mean, there's no day here, right? So when you buy a stock, I mean, we'll talk a lot more about investments in future chapters, right? But it's essentially the value of a financial asset comes from the wealth that can be created by the guy who is managing it, right? When you buy a stock, the reason the stock appreciates is not because someone decides to give you a rate of return, right? The reason it appreciates is because the management of the firm is creating value, right? So if you buy, say, a stock of Apple, right? If you bought it a few years ago, you would have done pretty well for yourself, right? If you had the foresight. Right, the reason the stock went up from $100 to $600 in the space of 5 years, right, is because the company created a lot of value. Right? They created some products, they marketed the products well, they packaged them well, they sold a crap load of them, right? They had a big profit margin, so they made a crap load of money. And as a shareholder of the firm, you're part owner of the firm. So if the firm, so if you own 1 millionth of the firm by owning 1 share out of a million, for example, and the firm created $1 billion worth of wealth, well, they just made $1,000, right? So it's not that there's some kind of cap or limit or whatever, right, that will give them. Now some investments are sort of fixed interest rate investments, right? If you buy, say, bonds, a bond is basically debt of the firm. We'll talk more about investment while we're here, I'll mention it, right? The bond in general promises you a fixed rate of interest for a certain time period, right? In general, right, so when a firm wants to borrow some money, they might float some bonds out in the marketplace. Generally, they give an increments of $1,000. So if you buy a bond, the firm promises to pay you some fixed rate of interest until the bond matures and they repay the principal, right? And so in that case, you know what is being promised to you, right? Or if you put it something like in a bank CD, they'll say, we promise you, like a 5-year CD, we promise you a 2% interest rate every year for 5 years, right? A fixed interest rate. Or if you buy some kind of an annuity product from an insurance firm, right? You give them some money, they promise you some kind of rate of interest on your investment, return to you by way of a regular payment every year for a number of years, right? So it depends on who is the they that we're talking about, right? There's a number of different financial products out there. So as far as the amount of investment, that really depends. In general, if you give them more money, they'll actually promise to give you more interest. Right? Because imagine, let's imagine that you are, let's say, I don't know, let's say you're a firm, right, and you want to borrow some money, right? You kind of have two choices. You can say try to approach 10 different lenders and say, let's say I want $100 million. Well, they can approach a bunch of people and somebody says, I'll give you $1 million. I'll give you a couple of million. I'll give you $5 million. Right? And so you end up having to manage, a whole bunch of different loans. And there is overhead involved in that, right? You have to deal with this guy and that guy and the other guy, etc. Right? Now, if you can get a loan from some large bank that says, I'll give you $100 million, right? You would be willing to pay him slightly more for this, for basically filling your whole demand and being done with it, right? It's a lot cheaper to do, right? So, and actually, if you look out for example, at some government bonds, right? Sometimes government bonds have a number of different types of bonds being offered. And you'll notice actually that some bonds have higher minimum investment. It would be like $50,000 minimum or $100,000 minimum. And it actually pays you a slightly higher rate than a bond that had a $25 or $50 minimum, right? Because again, if the government is borrowing, several $billion, or more like $1 trillion, right? It's a lot cheaper for them to deal with, investments of the size of 100,000 than it is investment of the size of $100, right? Because there's a lot more overhead. That's kind of the way it's looking. And actually, I recently, there's just kind of randomly, for other reasons, I looked at their website called israelbonds.com, and also Israeli government bonds. And you could actually, if you go there, you could see that, they have, one variable interest bond. I'll talk about variable interest as well. That has sort of a market interest rate plus a bit, right? Plus a premium. Generally, variable interest bonds, they have some kind of a market interest rate index plus a little bit, right? And then so as the interest rates go up and down, the interest that the bond pays you also goes up and down as well. Right? And so they have a bond that has the LIBOR plus 0.4%. LIBOR is a market interest rate index that we might talk about later on. And the minimum investment in that was like $100. And they have another bond which was LIBOR plus 0.6%. And I'm like, wait a minute, looks like exactly the same offer, but pays you more interest. What's up with that? And then you look at the minimum investment, $100,000. Right? So if you look at, if you go to the U.S. Treasury website, you will see a bunch of different bonds they offer. You will notice the same thing. There's some offerings that have a large minimum investment and actually pay you twice as much. Right? Thank you for that question. I'm sorry for that question, but we'll get to that, all that stuff eventually. Okay, any other questions? Okay, right. So this is right. So this is the thing, right? There is there's really again, depending on the investment you are talking about, there's no limit to how much you can get if you wait long enough, right? And for the purpose of investment, being relatively young and having several decades until you have to worry about taking money out of your investments, right? You really can capitalize on this extra time. Because remember, right, so we said $1,000 at 50 years is $117,000. Right, so let's say if you put $1,000 today, right now, and you just wait for 50 years, you'll get this much, assuming you get 10%. Now, what happens if you wait just one more year and you say, you know what, I really don't want to put $1,000 away into my IRA this year because I kind of want to, take a vacation to the beach or something, so I'll just put $1,000 next year, right? So that means that you have only 49 years to go until your retirement, right? So how much money will your $1,000 from next year turn into after 49 years of growing for 10%? So by waiting for just 1 year for that $1,000, you were giving up about $10,000 worth of future value. Right? Why is that? The reason is that the investment grows at 10%, and you have given up the last year's worth of growth. What is the last year's worth of growth? You would have gotten 10% of this, right? 10% of 100,000 something is about 10,000. Right? So by waiting for 1 year, you're not giving up the $100 interest at the front. You're actually giving up the $10,000 interest at the back. Make sense? Right? Because now you're growing for 49 years instead of the 50, right? You don't give up, you don't give up the 100 years, you give up the 2,000 at the back instead. And really, as far as like investment in a retirement account, you can invest some amount of money every year, right? So if you say I'm going to put in, $1,000 into the account every year, then every one of your investments is going to grow by a variable amount of years until the end. So before we get to about other stuff. Now here's a nice graph. Sort of looks like an exponential curve, doesn't it? And that's because it is. So currently the contribution limit for an IRA, and we'll talk some more about IRAs later on. A lot of this stuff is so interconnected. It's hard to choose what has to go first and what has to go next. So imagine, you're putting away $5,000 into your IRA every year, right? So if you put $5,000 today and let it grow, and let's say you have 50 years to retirement, right? You put in $5,000 today, and then you put in $5,000 in 1 year, and then you put in $5,000 the second year, and so on and so forth, right? And you might want to know, how much money will I accumulate in my retirement account if I do that and then wait for 50 years? So how would you do that? You would say, okay, so the first amount that I'm putting in today, I'm going to put it in and wait for 50 years, right? So assuming that I can get about 10%, and this graph is made of 10%, it's easy to make a graph of any rate of growth you want, and we'll look for the except for the label on the vertical axis. And then we'll change the actual dollar amount. And so how much do you get if you put in 5,000 and live for 50 years? Times 0 today, 5,000, and 50 years, it goes to how much? right? So that's, you know, so if you put in 5,000 today and wait 50 years, you'll get more than $500,000 if you get about a 10% average. Now, if you get maybe not stand but 8, maybe you'll get 400,000 instead of 587. Still a lot of money, right? So then you say, I'm going to put another one at time 1, which is next year, right? So I'm going to have 5,000 growing at 1.1 to 49, right? This one grows at 1.1 to 50, so it grows 50 years. And how much is that? Well, you give up 10% of that, so it's about 500,000. Right? And then you say, my second year, I put another 500,000. I'm going to grow at 1.1 to 48. I'm going to be like 48,000. Right? And so on and so forth, right? And then the last 5,000 that you put in here, you know, at the end of the end of year 49 here, right? Between 5,000, it grows at 1.1 just for 1 year until your retirement comes. Right? So that would be 500. Right? And so if you add all of these up, right, if you add up, you know, all 50 of these, you'll find that you'll end up with about $6.7 million in your retirement account. Or like 6.5, I forget what it was, right? But more than $6 million, which is like pretty awesome, right? Right? Now here's the thing, right? So that happens if you start, right? If you start doing this today, right? This year. It doesn't have to be like today, but like this year. Now let's say you say, okay, you know what? I really don't have that much money. I can't really afford it. So I'll just start next year, and then I'll go on from there. So if instead of starting from year 0, which is today, you start from year 1, you just gave back more than $500,000. Right? You say, you know what? I don't really have any money. Maybe I will start in 3 years. Oh, we gave back about $1.5 million. Right? So here's the thing, right? If you look at this, right, this is actually a graph of all of these $55,000 investments, assuming a 10% rate of growth, right? So you can see that this one, right, has grown by 50 years. So this is the one that you put in today, right? The next one has grown by 49. This is the one that you put in next year. This is the one that you put in after that. So the thing is, with every year you wait, you're starting to give up bits, not from this end, right? Because nobody cares about, peanuts. Screw that, right? But by waiting, you're giving up stuff from this end, which is where all the value is, right? So this is a sort of a visual illustration of why it is important to maximize the amount of time that your investment has. Right? Because assuming a positive expected growth rate, right? It's like a positive expected value proposition, right? Because if you're investing in, in the markets with people who are trying to create value, right? They're basically their work, their job is to create value, right? They're going to probably, on average, create some value, right? So, the more time you have, right, the more you get at the end. You're really significantly more, right? Because with every year, right, you are growing by some percentage rate relative to the previous principal. And the previous principal gets bigger and bigger and bigger. Now, let me just check the time. 2 minutes. Okay. Right, so here's the thing, right? We're working from a 50-year assumption and a 10% growth rate. You can work with an 8% growth rate or whatever, but you'll get basically the same picture, right? With every year that you wait, you're giving up the stuff, the cream from the top, right? Not the fiddling amounts from the bottom. Right? we will discuss. So we will discuss some more ideas about this and maybe delve into some more symbolic algebra. But I just wanted to give you, for now, sort of an intuitive feeling and idea of what we're talking about. You know, the effects of exponential growth, right? The effects of time on the results of exponential growth. Right, so I will talk to you. We'll continue from here next week, and let's go from there. Don't forget homework number 1.